Having a 401k is a great starting point for retirement. But if you simply accept the default settings your employer chooses for you, you are quietly bleeding tens of thousands of dollars from your future. We are going to fix that right now. In the next 6 minutes, we will run a complete audit of your account to find hidden fees, switch to the right funds, and restructure how your money is taxed later. Step 1. Pause this video, open a new tab, and log into your 401k provider's portal. Once you are in, locate your employer's summary plan description. Taking 6 minutes today to manually configure these settings will protect your money from massive, compounding losses over a 30-year career. Inside your benefits document, locate your exact employer match percentage. This is free money provided by your company, and your first priority is contributing enough of your own paycheck to capture all of it. But there is a catch. Search that same document for the term vesting schedule. Specifically, you are looking for the words cliff vesting or graded vesting. This graph illustrates the two main vesting structures, which dictate exactly when that matched money legally belongs to you. Cliff vesting keeps your ownership at 0% for several years before instantly jumping to 100%. Graded vesting increases incrementally. If you leave a 3-year cliff schedule in year 2, you forfeit 100% of the matched money. You walk away with nothing. Knowing your exact vesting date must dictate your career moves. Never leave a job weeks before a cliff date, or you will accidentally surrender money you have already earned. Next, navigate to your portal's Current Investments or Fund Details page. You are looking for a specific metric called the net expense ratio. The expense ratio is a management fee. The plan administrator silently deducts this percentage from your returns every single year, regardless of whether the market goes up or down. This side-by-side chart shows the exact impact of those fees. If you invest $200 a month over 30 years with an average 7% return, a low 0.1% fee leaves you with about $226,000. Increase that fee to just 1%, and your final balance drops to $184,000. If any of your funds carry an expense ratio higher than 0.5%, flag them immediately. That fraction of a percent creates a $42,000 difference over your lifetime. Ignoring a fraction of a percent in fees today translates directly into multiple lost years of retirement income later. Now that you have flagged the expensive funds, navigate to your Change Investments or Change Allocations tab to drop them from your portfolio. You need to replace these with broad, low-cost index funds that track major markets, like the S&P 500. Ideally, you want to select funds with an expense ratio near 0.1%. In some cases, you will find that your employer's plan only offers a terrible menu of high-fee, actively managed funds. If your plan options are poor, your strategy changes. Contribute exactly enough to capture your full employer match, stop there, and direct all your remaining investment capital into personal accounts outside the 401k. Reallocating away from active management takes the power of compound interest out of the plan administrator's pocket and puts it back into yours. For the final step, go to your contribution settings to review your current split between traditional pre-tax contributions and Roth post-tax contributions. A traditional 401k lowers your tax bill today because you contribute pre-tax dollars. However, when you retire and start withdrawing that money, every single dollar is taxed as ordinary income. The government will not wait forever to collect those taxes. At age 73, the IRS enforces required minimum distributions, or RMDs. They force you to start withdrawing money and paying taxes on it, whether you need the cash or not. This timeline tracks the life cycle of a traditional contribution. You get the green checkmark early on, but at age 73, forced withdrawals trigger. If these mandatory distributions are large enough, they can easily push you into a significantly higher tax bracket in retirement. By contrast, the Roth option works differently. You pay the taxes up front. Because the taxes are already settled, your withdrawals in retirement are completely tax-free, and you entirely bypass RMD requirements. Based on your current income and future expectations, restructure your contributions now. You can split them between traditional and Roth, or move entirely to Roth if your plan allows it. Deciding your tax strategy today prevents the government from dictating your withdrawal amounts and tax burden in the future. You have now successfully completed your audit. You've stopped the fee bleed, secured your matched money, and insulated your future withdrawals against tax hikes. But optimizing your employer plan is only the first foundational block in building a completely tax-free retirement fortress. To gain full control, you need a separate, tax-free bucket of money that operates entirely outside of your employer's control, a personal Roth IRA. To continue setting up your system, click the video on screen titled How to Build a Roth IRA from Scratch. Real wealth isn't built by default settings. It is built by actively managing and optimizing the specific financial levers available to you. I'll see you in the next video.